Some say the inverted yield curve is bad news, may signal recession. Never heard that one, have we? Well, this is dated 30 January 2006, and from an article in the Courier, Waterloo, Iowa. And from my newspapers.com subscription, I just typed in inverted yield curve, and I came across, I just came across a ton of stuff here. So, Capital Times, Honolulu, inverted yield curve, maybe yield recession. Who's afraid of the inverted yield curve? The National Post. Anyway, so let's go back to that article. Just tons and tons of stuff to look at when it comes to this. This is just an op-ed from a guy named Malcolm Burko. And the gist was, and I don't know who this guy is, but the gist was we had a couple in Canada from Gulf, Ontario, down in Boca for the summertime, or wintertime, I guess. Yeah, I guess winter. And going back up to Canada. And he goes, I keep hearing about this inverted yield curve thing. Can you explain how it works, what it means, and why it's important? Please answer before we go back to Canada because all my investments are in the U.S. Oh, no. And so what Malcolm says is we know what the inverted yield curve essentially is. The short-term yields are higher than the long-term yields. All right. So what he says, the curve inverted during the week of December 27, 2005, when the interest rates on short-term bonds exceeded that of the 10-year. Inverted yield curves make many economists quite nervous because they distort the common principle of bond investing. You should get more return for the more risk you take, i.e. the longer the maturity. The last time we had an inverted yield curve was in 2000 when Alan Greenspan was the chairman of the Fed, and you know what happened to the stock market then. So when the yield curve inverted in December 2005, the Dow crashed more than 100 points. Many economists believe that inverted yield curve is bad news and presages a recession. All right, when the Fed thinks, all right, so he talks about to slow the economy, and Greenspan pushed up short-term rates so much that they finally rose higher than the long-term rates. As a result, business activity, consumer purchases begin to slump, blah, blah, blah. All right. And it may lead to market crashes as it did in 2000. It's just the idea that the crash was whatever. We can make this argument until we're blue in the face. What caused the crash of 2000? Well, nosebleed price-earnings ratios. That's all there is to it. At some point, it's always the Dutch tulip mania. There's always a person holding a wet bag, the greater fool theory, and at some point, it's going to pop because people say, why would I pay $100 for every dollar of earnings? It doesn't make any sense for a pets.com website. It's difficult to stop the momentum, and some observers believe that rates will move to 4 3/4 from the current 4 1/4, which ultimately did. But the Fed is so prone to overreacting, it's quite likely to do so today. I guess the open market committee was happening that day on January 30th, 2006. Therefore, the consensus among the 9 economists I spoke with favors recession this year. All right. So regardless of what happened to the economy in terms of recession, because remember, this guy wrote in asking Malcolm what to do about his investments. He says his investments. So he's not saying the recession. I'm a business owner. What should I do to prepare for inverted yield curve, which would lead to a recession? What do I do with that? He's saying, how should I deal with my investments? So now he has his paper. He's reading on January 30th, 2006. He says, oh no, inverted yield curve means recession. And he's imputing that to mean it means a stock market crash. Because remember, in 2000, when the inverted yield curve happened, we had a stock market crash. All right, so let's look at what happened here. So I'm just going to do a chart from finance.yahoo.com, the S&P 500, and we're going to say he got this. Now, he's reading this as of January 30th, 2006. That's when he read his paper. And he's going to say he did nothing. He just sat on the sidelines and did nothing. And for the next 22 months, until October 3rd, 2007, he made 21% on his money. 21% from just sitting there doing nothing. Now, let's just say, on the other hand, he said, oh, no, I'm going to get out of the market because I just read what Malcolm said, and it says inverted yield curve leads to recession, leads to, again, the insinuation stock market crash. Well, if he would have done that, again, he would have missed out on 20. Let's go back to October, right there. He would have missed out on 21 right there. What was that? Hold on a second. Yeah, July, October, right there. He would have missed out on 20, again, up to 21%. In this case, 25%. He would have missed out on a significant return on his money, without question. Without question, he would have. Let's go back here. We want to go right October 3rd. Now, if I may, remember, In June of 2006, at least that's when the real estate peaked out. I don't know if that was actually overall recession and the overall GDP of the economy. I don't know. I don't recall. But at the end of the day, in June 2006, when the real estate market just peaked out. And that's when the air began to pop in the real estate market. We can look at GDP to see if that was recessionary or not. But it doesn't even matter. Let's just say it was. So let's say for the next 2 quarters, we were in a recession from June 2006. So that'd be the last 2 quarters of 2006. It doesn't. What did it do to your stocks? Nothing. If you made money. So the idea that the recession insinuate or the inverted yield curve insinuates recession, that in of itself is fine, but it doesn't mean for stocks. It means nothing. We had 22 months. If this guy got out because he read this paper, said inverted yield curve is bad news, may signal recession. He sat on the sidelines while all his buddies were making money in the market. So he's sitting on $100,000, earning 4% in a CD, whatever, which isn't bad. I get that. But at the end of the day, he missed out on 22, 23, 25% upside. So how long would he have sat there, just sitting there idle, and then he's probably going to say, enough of this, I'm getting in. All right, so what happened from this October 3rd? So in October, we'll go to 2009. All right, so we're going to go to 03/09/2009. So from then on, he proceeded to fall off a cliff. All right, so what we'll see here is right there. So that's basically October 3rd, 2007. It was when the market hit its peak. Then we had a normal ebb and flow of the market, a normal decline, and it fell back to in August 2008. We're talking 2006, 7. We're talking almost 2 3/4 of a year. We're talking 24, almost 34 months, 35 months, almost 3 years. So from basically June of 2000 or January of 2006, when he first got wind of the recession because of the bear market, until August of 2008, he was only up 0.9%. But that's even with the quote-unquote stock market crash of 2006 going into August of 2008. That's just October 2007 to August of 2008. Just not a big deal. I mean, it's just a regular market crash. So he went up, and now he's back to even. So literally, more than 2.5 years later, he's still sitting on a positive return, even though he didn't do anything with the recession. He stayed in the market, and then he took the fall. He's still sitting there. And then you can see the federal intervention, the Fed intervening, and that's what caused this. And, of course, the Feds, because they're always rent-seeking, always looking to expand their bureaucracy. Hank Paulson and all these freaking fools said, if we didn't do anything, we'd be speaking Chinese now because the commies would have taken over. And yet this is where you see the intervention right there. And just all the shenanigans that happened. That's when McCain said, I'm going to suspend my campaign. It's just the whole thing. It's just freaking, the politicians don't know what the hell they're doing. The Federal Reserve Board don't know what they're doing. No one knows what they're doing. It's just nuts. Anyway, and this is where you see the negative that came in. But this had nothing, literally nothing to do with the inverted yield curve from January 2006. This is a completely different market cycle. It's a completely different event that happened. So the idea that the recession, the inverted yield curve leads to recession, leads to market chaos, well, it's simply, there is no validity to that at all. I mean, if you did nothing, you made 21% on your money. Even if you did nothing in a normal market decline, you're still breaking even essentially after almost basically 3 years. Now, when the Fed intervened, you got crushed. Don't get me wrong, you got hammered. But what do you think happened? This guy, let's just say he sold. He's riding, he's idle, then he buys back in, probably here, maybe here, and then he proceeds to get killed. So what do you think he does here? He sells at that point. So he sells here to avoid the recession. And then he buys back in because he can't take not losing any money anymore, not being in the market. Then he proceeds to get killed. He probably sells here, and he says, I'm out, I can't take it anymore. And so what happened from then on, we'll go to the end of today, and we'll just say 10/1/2019, and then you'll see the silliness of this whole thing. And right there, apply, and look at that. I mean, so he got out. He bought back in probably because he could fear missing out. He went down here, got out, and he said, I'm not getting back in. And he probably got back in here or something like that. I don't know. But at the end of the day, good chance he missed all this right here. One of the most prominent bull markets we've ever seen in history. It's not just attributed to Obama. It's not just attributed to Trump. It's not. It's the nature of the beast. It's just once you have a huge recession like that or a huge decline like that, generally speaking, you're gonna have a big up. And we had a market sell off right here, and that's the end of 2000. And we had a couple here. We had that decline. I think that was in May to August of 2015. We had this at the beginning of 2000 and the end of 2018, and then we're right back here. So he would have missed out. So if he would have stayed in the market, fast forward from 2006 to 2019, he would be up 127%. And I don't even think this assumes dividends either. So he would have missed a doubling of his money, even dealing with this right here, the 2007 to 8 to 9 chaos. The point is, you just can't. Look at this. I mean, here's, oh my goodness, what year is that? Hold on a sec, I gotta go here. That was 2000. Yeah, that's 2011. There it was. July to August 2011. We had the 2015 chaos. We got the, I don't even remember that. The beginning of 2017, yeah, after Trump got elected, right there, the first quarter, the end of 2018. And yet here we are. We're still well above where we were, even if he dealt with the recession or the inverted yield curve led to a recession, which led theoretically into to this, but it didn't. Anyway, so the whole point is we've heard this story time and again. Inverted yield curve may or may not lead to recession, but what does that have to do with your stocks or your investments? Nothing. So just sit tight and don't do anything. Unless you're really saying, I can't take the volatility, then get out. Don't wait. All right, we'll see you next time.